have a practice or are you running a business? Valuation is the ultimate KPI.
Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor Podcast, brought to you by Truelytics, the one and only comprehensive advisor transition management platform. In this episode, Terry Mullen is with me again, and he and I are joined by Owen Dahl for an exploration of how the COVID-19 pandemic is likely to affect valuations, transaction volume, and deal structure for financial advisory businesses over the course of the next few years, at least. Owen is one of the best people in the world to weigh in on this topic because he's one of the OGs, the original Gladstone folks. His insights and analysis provided the foundation for the models that are powering the software that Truelytics acquired years ago from Gladstone, and many of those models are still in use today. So we're really excited to have Owen with us. By way of introduction, Owen currently leads the Dahl Consulting Group, an economic consulting firm offering business valuation and litigation support services for select clients throughout the United States and Canada. Before Gladstone and the Dahl Consulting Group, Owen was a principal at Moss Adams with a special emphasis on the area of intellectual property, and he was the partner in charge of the firm's financial services consulting business. Owen holds a CFA, Chartered Financial Analyst. He's also a licensed international financial analyst, and he's an accredited senior appraiser. So Owen's kind of a big deal who knows his stuff when it comes to business valuations and the market for transactions. This is a really important episode for individual advisors, RIA ownership, executives at broker-dealers, and wirehouses and so forth, because we are entering a period of great uncertainty, and it feels like that's an understatement of the century, but it is one of those once-in-a-100-year type of events, as everyone knows, and it's unlike anything any of us have experienced, right? As you'll hear Owen talk about in detail, this crisis is a little different than the 08-09 financial crisis. It's different than the dot-com bust. It's different than 87. It's different than a lot of other things we've seen before. We've seen recessions before. We've seen economic shocks before. But things are likely to be slightly different. And it's going to have a big impact on our business, not only at the business level, but especially at the transaction level when it comes to M&A, when it comes to succession, emergency continuity, as we talk about a little bit in detail here. So, please do tune in, maybe listen to this podcast a little more intently. As always, make sure you share the podcast with your colleagues and your social network, because the things we cover here may be of great benefit to other advisors and your peers in the industry. And we want to make sure that everybody gets the information, okay? As always, please do make sure you like and subscribe to the podcast. We're on Spotify, Stitcher, SoundCloud, Apple Podcasts, Google Play, wherever you like to get your podcast jam on. If you have questions for Owen, his contact information is going to be shared here toward the tail end of the podcast. But if you want to just shoot those at us, podcast@truelytics.com. We'll make sure we get those to him. You can always hook us up on the socials, LinkedIn, Facebook, Twitter as well. And of course, we're over on the YouTubes as well. All these episodes are being posted up on YouTube if you like to just kind of have YouTube on in the background while you're doing your thing, okay? Well, without further ado, let's get to the conversation with Owen Dahl, with myself and Terry Mullen. Let's do it. Well, Owen, thank you so much for carving some time out of your day to spend it with Terry and myself. We've been talking about you internally here, and we're really excited to have you on the show. So welcome to the Modern Financial Advisor Podcast.
Absolutely, my pleasure.
So I thought we could kick things off and set the stage a little bit. We've been talking on this podcast and elsewhere over the past year or so that we're likely entering a period of very high advisor transition with, 40% of advisors now 60 years or older. One would expect a large number of those folks to retire or otherwise exit the business in the coming decade. And we saw some other stats like that reported recently where there's this expectation of a large exodus from the industry in the coming decade. However, this COVID-19 pandemic is likely to change a lot of the assumptions that many advisors and wealth management firms may have had about the wave of transitions to come. So I thought maybe we could jump in the time machine before this and see what happened in 2019, right? Like, how's the world changed since then? what were some of your core assumptions before the pandemic for deals and the expectations that you and others had for the advisory business as far as transactions were going to go and valuations and so forth? So maybe we start with you, Owen. What were you working with from an assumption basis, back in December?
Yeah, it's a great question, and we think of assumptions as being, forecasts of the future, and there's certainly some element of that. But I think more fundamental to the question of transition is the idea that risk was somehow measurable at a point in time in a way that we weren't used to. And normalcy happens, we're at the end or tail end of a very longest bull run in the history of the stock market. And there was a complacency about risk that was built into the way people thought about transactions and pricing deals. When you see, and I'll give you an example, actually, I do a lot of litigation work, and a lot of experts had begun to value, for purposes of setting price in litigation, these expectations of growth that were backwards looking. The equities in financial services companies had grown annually at a compounding rate of 15 or 16%. It therefore presumes that it should continue at that rate in the future. Obviously, that's problematic because nothing's going to grow at 16% in perpetuity. As a matter of fact, the financial services industry since 1950 has grown at a compounded rate of about 5.2% in nominal terms. So while we would, in the valuation term, look at valuation with that more conservative 5.2%, where I think the real distinguishing feature going forward is relative to what we thought about in 2019, we thought there would be some sort of normalcy that would continue, and that pricing of that normalcy allowed buyers to be a little bit more risk aggressive as they made transactions happen with sellers. And I think what's happened, and we can jump back in the time machine and go back another decade to really see how the market thinks about risk. Risk does get priced into deals in two ways. One is obviously what we call value. The other is term. And what we thought would be the expected exit strategy of 3 to 5 years could very well now be 7 or 8 years, as sellers are going to be forced to accept some realities. And that big reality is we are in a really uncharted territory here in terms of pandemic risk. We don't know how to deal with pandemic risk. We know how to deal with market risk. We know that things go up and they come back down, and that turnaround has historically lasted 18 to 24 months. We're seeing this play out in every day in the stock market, and the returns that we're seeing in the stock market. The bigger drivers currently of day over day returns are being generated by the probability of a vaccine being in the marketplace in 12 months. These are things we've never dealt with before. Markets have a way of dealing with it. They deal with it by forcing risk away from the buyer and back to the seller. We saw that in 08 and 09. The difference, I think, the fundamental difference between then and now is that to date, at least, we haven't seen a complete collapse of the credit market. So there's still liquidity in the financial markets. If that left, we would probably be seeing some real problems.
No, I would just add the difference if you go back, 12 months into 2019, even in December, I would say that it was a seller's market, and in part drove some of the things that you heard Owen talk about, right? Buyers had to be more aggressive because there were more buyers than there were sellers. Some of the statistics that I've seen were for every person that raised their hand that said that they were interested in selling, there were roughly 50 people that raised their hand that said that they wanted to buy. Now, I don't think that there were 50 qualified buyers, but there were 50 people interested. I think at least right now we're seeing a shift to it being, again, more of a buyer's market potentially if this thing lasts significant time, certainly short term. And we'll see what happens, how quickly we can recover.
Other than it being a seller's market, Terry, as you mentioned, or viewed as a seller's market prior to the pandemic, What other assumptions did you see like broker dealers and RIAs kind of baking into their calculus for what's to come for the transition wave that they expected to happen?
It's funny. One of the things, when we talk about deal structure, and I know Terry and I have talked about this a few times over the last several weeks. One of the things that I'm always amazed about when we get to the end of a very aggressive business cycle is we'll talk to buyers and we'll be very cautiously structuring deals and talking about deal term that protects their downside. And buyers become their own worst enemies when things are really good. They start to talk about giving away contingency pieces. Well, I don't really need that downside protection. I'll buy it for cash. I'll buy it for cash and a note without any recourse if things turn around. That's the first thing that goes away. That's gone. That is absolutely, in my opinion, gone from the marketplace today, unless you're looking at fire sales, cash prices for transactions and practices that have been affected by advisor fatigue. And advisor fatigue is a real thing. I know in 08, 09, 2010, there are a lot of people who just wanted out. That's simple. And we'll see that again.
Yeah. I think that there were elevated multiples, depending on what thing you wanted to add the multiple to. If historically it was in a range of, I'm just using as an example, 5 to 7, you saw that moving up from 5 to 7 to 6 to 8 to 7 to 9, and that again, it just gets to the point of the value people were putting on it. Growth rates were significant, and they were using historical growth rates instead of projected growth rates. But I think people are coming back to earth, and the other thing that I'll say is that for so many people in this industry, it is a lifestyle business, and you can continue doing it into your 80s in many cases, or 90s. You may not work as hard, you may not have as many clients, but you can still do it. With everything that's going on and the fast pace and the changes, I think even that you got that fatigue that Owen mentioned, where I think a lot of people are saying, is it worth it? Maybe I should just try to find somebody that can buy this and move on.
Yeah. And it's funny when we think back again, looking sort of historically the last 7 or 8 years. I think the industry's grown up a little bit and matured a little bit, but there's still a lot of people out there who haven't effectively planned their transitions and were maybe in the process of it or had started thinking about it. And this is going to have a real significant impact. Contingency plan, despite the fact that for many of them it's been regulatorily required now for about 7 years. No idea how they're going to exit if they were to get sick. These are the fundamental issues that are going to affect everybody in the marketplace. And we could say, oh gosh, it's going to be a wake-up call, but 08, 09 should have been a wake-up call. And the very good firms, the very good firms had buying opportunities then, they will have buying opportunities now. Firms that stuck their head in the sand and pretended to be ostrich will face this in pretty dire circumstances, I think. And the problem with, I get asked all the time, well, we're buyers, we have cash, we have capital, we have the ability to buy, go find us some opportunities. The problem is the sellers are going to be the ones that are fatigued, and that they're the ones that didn't do the fundamental things that are necessary to operate your business. Pick up the phone when the market is down, call your clients, check in on them, do the things that you're paid to do. And at the end of the day, if you don't do that, somebody else is. And the transition risk is so significant at that point in time, because you've got down market, you've got upset clients, and you've got advisors who can't be found.
Yeah, and that's a problem. I mean, fundamentally, I think, Owen, what you mentioned at the first part of your comments just prior was it was almost like the cobbler's son, right? Is the one that has the holes in his shoes. And in this industry, the industry hasn't taken its own advice. There is no way that a good financial advisor who is advising a small business owner client and found out that they didn't have a proper plan in place, if they in fact got hit by an Uber, they would force them to do that. And in many cases, they didn't even do it. What Owen mentioned at the end was, right now there's so much fatigue, they're not even doing the things that they need to do to drive the business on a day-to-day basis, like reacting to clients and reaching out to clients and doing the like. So I think that's just the nature of how quickly this thing came on and how disruptive it's been.
It's kind of funny and counterintuitive, but when financial statements are squeezed and you see revenue declines of 20 and 30%, you see a lot of advisors become very defensive with their advertising spend and the things that are maybe a little bit more discretionary, which is actually counterproductive. This is a point in time where you need to be really proactive in terms of reaching out and reaching your clients because there's turmoil everywhere. And we saw that. We had some really good RIA clients in 08, 09 who really went aggressively into the market and looked for new clients and came out of that with those client relationships and assets that are depreciated suddenly grew over the next decade to become $3, $4, $5 million clients and rode the wave pretty well.
We've been talking a lot about that, about this is the time to pounce, right? This is when you should invest. And frankly, many firms are probably sitting on unspent investment, right? On their marketing, right? They normally are going to conferences, especially on the asset manager level. They sponsor all these conferences. They spend hundreds of thousands, if not millions of dollars a year with these efforts to get in front of advisors. And now they're just sitting on that money. Same thing with broker dealers who host those conferences and so forth. There's a huge opportunity here for you to invest so that when things start to recover, you're like so far ahead of the pack, you can't believe it. So, we've been talking a lot about that concept.
I mean, that goes from the top of the house, in terms of the industry, like asset management firms, product providers, custodians, down to, large RIAs to small RIAs. They all had some budget that they were spending on client facing travel, going to conferences, et cetera. Well, that's not happening. And maybe that's 10% of your budget. They should be redeploying that to things in client acquisition, particularly, at the consumer level right now.
Yeah, absolutely. So you mentioned a couple of things, Owen. You teed up the concept of, this market event, this crisis is, not exactly like previous crises. In some ways, we don't know what to expect. But I wonder if we could talk a little bit about what we've learned from those previous crises. I mean, I can understand, number one, why people are a little freaked out and, like you said, a little tired, a little exhausted, and have that fatigue. And they're maybe looking for the exits. I mean, this is the third black swan event that many of these advisors are encountering in their life, right? You had 9/11 coming right off after the dot-com bubble burst, and then you had the 08, 09 crash, and then now we have this, this once in 100 years type of experience. Hopefully it's once in 100 years. But how is this different, right? What are some of the, the differences and what are some of the more pronounced impacts of these economic shocks to advisors and firms who are looking to maybe sell or buy a practice in the aftermath?
Yeah, good question. And I think when you're in the middle of a crisis, it's easy to find the dissimilarities between the past. The 07, 08, we've never seen the complete collapse of the U.S. economy. We were seconds away, if you believe it. You never saw our banking system at that stress point. 2001 and 9/11, we had never been attacked. We didn't know how long the cost and complexity of the war on terror was. And I think there's similarity as we are obviously starting out on a long path here of uncertainty as far as when a vaccine will be ready, when we will be able to find the right testing levels, all of these things that we had no idea about. We didn't talk this language 3, 4, 5 months ago. So in the uniqueness, we find similarity. The uncertainty, as I mentioned before, that creates price pressure. In this market, in any private equity market, price pressure plays out in terms of return, but it plays out, I think, more appropriately in terms of term. And in this case, where we can really go back and look at the past is we can see two things. One, backwards looking pricing multiples, which are really good for quick and dirty conversations, tend to become less important during market crisis. I'll give you an example. In 08 and 09, I retained a spreadsheet on my desktop of price earnings multiples for the large financial services companies. They fell by 70 and 80% because earnings fell more rapidly than price did. So price stays up, earnings fall, the multiple gets really, really big. It looks like we're overpaying for earnings. The reason we're not is that there's an implication things are going to get better. There's an optimism built into the marketplace. And that optimism is effectively what we capture when we think about discounted cash flow analysis, about forward-looking projections, about thinking about the future. Right now, it's really hard. But with time, we will start to see some comfort and some clarity. And funny enough, as we get comfort and clarity, you're going to see the biggest disconnect between historical pricing models and forecasts, because we're going to be further into this cycle. So the companies are going to be more affected. The returns historically, the last year's profitability is going to be worse and worse and worse before it gets better. I agree on that. When it's near turning, that's when you'll see the largest transition between forward-looking pricing multiples like a discounted cash flow analysis and backwards-looking pricing multiples like price earnings ratios, and particularly price earnings ratios. It's times like this where you get massive volatility in PE and it becomes useless from the perspective of forecasting value. So I think that'll happen for sure. I think we're going to see a lot more requirement to be thoughtful about value. We're gonna see our clients really more than ever seeking expertise about the value of their firm. More importantly, there's going to be a bridge between the buyer and the seller. They're not going to be on the same page as they talk about negotiated transaction. Buyers and sellers are going to have to come up to concession that looks a little different than just price concession. They'll concede in terms. So I'll give you 2 years of an ability to sweeten the deal in terms of better than forecasting earnings if we meet certain targets. Those kinds of things will become more important in the deals again, contingency pieces on the backside. If we don't hit benchmarks, we don't hit certain pricing benchmarks, I'm not paying you the other 30% of the deal. Those are going to be fundamental to making deals happen. And if you're a seller and you're 75 years old and you didn't do a very good job planning for your retirement, those concessions could be really, really significant.
So, one of the things we haven't talked about too much in depth just yet is the increased risk for advisory businesses presented by COVID-19 specifically, right? We've talked a lot about, the underlying market risk, the financial risk that because of the economic hit that might happen or is expected to happen, and how long that might take to recover and all the other machinations of it. But as I predicted, a while back in the Truelytics blog, the era of free money is going to be over soon. And I think we're seeing that, right? Many firms, as you've kind of alluded to, rode this wave of a bull market and they just assumed, hey, I'm kicking butt here. I'm an elite advisor because I make more money every single year. I'm a great broker dealer because we're just going up and up and up. And suddenly that free money ride is over. But now if we look beyond that revenue risk, this pandemic shines a bright light on the risk inherent in an advisor population and their client base, because as we said earlier, 40% of them are 60 plus now. And under conditions, a firm can expect 5% annual risk mortality rate in a population that's 60 plus. And so now that we look at COVID-19 and how susceptible that population of advisors is, 60 to 80, I mean, you could over 10% mortality rate in an advisor population that skews older. And then if you look at their clients, the risk is equally pronounced because many older advisors have older clients. So how do you see the increased health and mortality risk affecting the transaction market more broadly, right? Not just valuations, but the marketplace?
Well, and I think it's almost a non-starter conversation for your typical buyer and seller. They don't know where to go, and none of us do. We really don't understand, as I mentioned before, the veracity of this in a time frame. We know how bad it is now. We believe it's going to get worse in the fall again. We don't know the vaccine questions. We don't know the testing questions. And markets have a way around that. And the way around that is the term structure. And as I kind of keep alluding to, I think what you're getting at is, it's going to become an integral part of every deal we see, where mortality rates built into this valuation are 5%. If they're 10%, you as the seller are going to be the one that is charged back. So we're going to see a lower upfront payment for businesses. In fact, in 08, 09, we saw zero down business deals all the time, where the amount of upfront payment fell, the amount payable over time in a low interest note grew, and then that back end, the payment, if things go really well, grew as well. We're going to see that again. That's the solution. That's the market solution to an uncertainty that just simply can't factually be priced. The only way you price uncertainty like that into a deal is by dropping value. And if you drop value, there's a point where, to Terry's point, these are lifestyle businesses that we're talking about, and there's a point where you tell the advisor, I'll give you 1 times revenue. He says, screw it, I'll just stay and work the extra year. And that becomes sort of that baseline of the conversation. If you want more, if you want a premium, I'll pay it to you, but you're going to have to show me.
Makes sense. Terry, I was thinking, that what we may see here is a level of urgency creep into the market on the seller's behalf, right? Like if I realize I'm 65 or God forbid, 75, like you alluded to earlier, Owen, if I'm an older advisor and I look at my client population and they're older, I might get scared to try to make a move faster rather than, sooner rather than later, because geez, the value might not be there for me later. I might not be here and my clients might start falling by the wayside. So I might accelerate my exit process. What are your thoughts on that?
Well, I would say that if they haven't already been doing it and in the process, trying to go into it quickly is not necessarily going to yield them great outcomes, and they'd be better off focusing on making sure that they keep their clients, at least right now, while they're doing it. Because to Owen's point, if you're only going to get 1 times revenue, you can continue doing what you're doing and get that, and then maybe get it next year, and it goes up, or it doesn't. You still have those clients and that income that you're going to be able to make. But I think there's just so much uncertainty. The question about mortality and if that's going to significantly change, we don't know. I mean, we really don't know, and it is certainly impacting older people that had pre-existing conditions or were already had comorbidity, but we don't know. We don't know if it's going to come back in the fall. I think people are going to have to start to figure out how to work in an environment where you can have face-to-face meetings with clients, or it's going to be curtailed, and you can't do seminars the way that you used to do seminars.
Definitely.
A whole host of businesses or industries are not going to come back the way that they did. And look at your client base. Do you have clients in those businesses? And maybe we should start to think about your business from a bunch of different perspectives in how you're going to deal with it moving forward, because we are in uncharted territories from the way that we deal with it. Obviously, valuations and deals are going to be, buyers are going to dictate that right now. And all of the things that we've already discussed are going to be impacted. But at the end of the day, people still need financial advice. They need financial advisors, and they need, to know what they should do now more than ever.
You made a really good point there, Terry, about thinking about your client mix and how they make their money, right? If you have a bunch of restaurant owners in your client base, right? And by the way, there's nothing wrong with having a niche that you focus on. Like, I serve people who own business, but if you look at your client base, and it's not just high risk from an age perspective, but oh my gosh, like, how is the world going to change with maybe the next year or so? People are still not going out to eat as much, and there's a lot more social distancing. There's restrictions on capacity that weren't there before. How's that going to affect your business? I didn't really think about that. I think that's a really smart way of starting to analyze your business.
Well, there just are so many things that you just can, it's almost a domino as you start to think about it. But yeah, every business is impacted. Some will be positively impacted. Most will most likely be negatively impacted. And there will be a host of new industries that pop up and that succeed really, really well. And, you know, but getting your house in order and dealing with it the way that you can, being proactive as we talked about earlier to your clients and letting them know what's going on. I mean, right now, to Owen's point about the prior problems in '08, 8, and 9, we have not seen a complete blow up of the credit markets. Liquidity and credit is still available, but they're you know, but we're also borrowing a lot of money, and who knows what's going to be around the corner with that. But we're still in a fairly decent place given everything that's going on.
Yeah, the asset revaluation, has happened in the equity side. When I think back to the fall of '08 and into the spring of '09, we were at Moss Adams. We were actively involved in auditing bank stock. The collapse in the market, which began in September or late August, accelerated into October, took the real estate market, the REOs, out in the winter, and were repriced on the balance sheet of the banks in January and February, are really the catalyst that created the complete collapse in liquidity. And that's going to happen. I'm not saying it's going to happen to that degree. I think there's a different mindset at the Fed, and we don't know how that's going to play out. It's everybody's guess, but the news is still to be determined, and that's the risk. That sits, to me, sitting here today, as an active trader, that sits as the biggest market risk that we're facing right now.
Sorry, Owen, I really didn't answer the question about that advisor who might be now looking to sell. What are your thoughts on that? And what advice would you give to a 65-year-old advisor who is now thinking that they should maybe get out?
Well, if their purpose is to get out now, quite frankly, do us all a favor and get out fast, because you're ethically not the right person for your clients. If there are health issues and you haven't planned for that, I feel for you, and God willing, that's not the solution issue that we're dealing with. But if you're 65 and this is your reason for leaving, you should have been working a lot over the last 5 years to be prepared for this. And the fact that you didn't stick around, you're going to have to, because if your purpose is to protect your asset, I really think about advisors as being motivated in two ways. My dad was a financial advisor, and I grew up with this. I know that my dad felt an ethical responsibility to see his clients through times like this. I don't think my dad would have even thought of retiring at the middle of the 2008 pandemic, not because he was concerned necessarily about the protection of his own wealth, but because his clients were calling him every day and he was picking up the phone. He had work to do, in similar fashion to a doctor who has work to do for his patients right now. When the time is right, though, I hope this is the catalyst that makes them start looking around and thinking about their exit strategies, looking at using some of this very, very lucrative wealth that the financial services industry just put in the hands of the typical 65-year-old advisor to hire, train, and be ready for the next generation. That's the only way you're going to get out of this anyway. And if you're running for the hills because your beach property in Florida is in jeopardy, shame on you. Shame on you for being here and not being prepared.
When you look at the industry, right, the people that we're talking about right now, the 65-year-old person, they didn't start out as an independent financial advisor.
Probably not.
It's almost certain that they didn't.
Yeah, good point.
They started out at an insurance company or a wirehouse or a bank somewhere else.
Yep.
And at a time when retirement was 65 or whatever, and there was a retirement package, a pension or a payout if you were at a wirehouse. There was some predetermined amount that you would get when you got there based on your last couple of years or whatever. And that's what you knew was going to be there 30, 40 years in advance. Once people moved independent, retirement shouldn't even be a term, because you're a business owner theoretically, right? And the only way you can retire is if you sell your business, right? There's not, unless you have built some sort of larger organization, RIA, that has some sort of plan. The only way you can do it is to sell your business to somebody else. And that is not that it just happens automatically at 70 years old or 65 years old. That is a planning process that should have started 10 or years ago or 5 years ago at a minimum. And if what Owen was just saying, if you haven't been thinking about this and you're doing it now, do it quick, or do it because or don't, because it's, you shouldn't have been there. And I don't know that people really realize that was another one of those things that they had to take on when they went independent.
Yeah, no, it's actually a really good point. And you see it in the way that they approach the value of their business. My business is always worth, 2x. Well, not, I mean, it's very dependent on a number of circumstances of which you're in control of many of them. And there's a couple of them, like exogenous risk, that you're not in control of. The ultimate answer to the question is, what does the seller do today, depends entirely on what his exit strategy is. If he's still okay being in the business for 2 years, 3 years, there's never a time like the present to be preparing for transition, whether the market's good or bad. And if they haven't started that preparation, they should start now. It probably doesn't involve listing their company on a bulletin. Probably consists of something much more comprehensive.
So on the flip side of this, it does raise the possibility that if I'm a buyer and I was planning on, hey, listen, I want to grow my business through acquisition, right? I want to be able to grow rapidly. It starts to feel like now you might have your pick of the litter here. If you were a buyer today, you're looking to grow your business aggressively, what would you be looking for? Like what would you be hunting for, thinking about as you approach what could be bargain shopping season?
Demographics are still driving good businesses, and quality management is still imperative. I think my biggest advice to them would be cautious, because as I've sort of said a couple of times now, the sellers are going to be motivated by a need to get out, a willingness to take a discounted price. And you have to ask yourself critically, what is it about the way they run their business that makes them want to run for the hills today? So, I mean, there's going to be transition. There are natural transition. I had a client, we were just finishing the last third. He sold a third of his practice to each of two partners a year ago. It's time for that third. We're in discussions right now to make that happen. He's okay with the discount on that last third. He's had this in motion for a while. He understands that he's transitioning some clients, and he's willing to accept it in actually a 15-year term in that for that last third. The plan was in place. It had been well executed. He had brought two really quality people in to run his business. He had been able to step aside and give those client relationships chance to foster. So yeah, he's impacted. Is he impacted by 30%? No, he's probably impacted in aggregate by 5%, 30% of the last third. Those are the good stories. They're going to continue. I don't think, if you're looking for fire sales, you'll find them, and you're probably going to buy something on fire.
That's a great one. I'm going to use that. I'm stealing that. I've never heard that. And that will be in my lexicon going forward. And I may attribute you, or maybe I'll just say that's mine. That'll just be mine from now on.
Take it.
That's right. Shameless stealing, right?
After you say it the third or fourth time, it will become yours.
Just pay me royalties.
So wrapping things up here as we kind of reach to the end. Oh, I imagine as people listen to this, many people may want to reach out to you and talk to you. So let's talk a little bit about, if you don't mind, how clients work with you and what they might expect if they reach out for an engagement with you, and if that engagement might look a little bit different given the current pandemic situation, or if it's kind of business as usual. So what's it like to work with you? What do you do for clients?
Well, it's a good question. I don't even know. No, just kidding. Being on the phone with Terry is actually a privilege, because I really strongly believe in what Terry and the Truelytics guys are doing. The product, if you're looking for something to price your business, if you're looking for something to sort of give you thought leadership, it's an exceptional place to go. Most of the time, people are going to end up with me when they're beyond that sort of planning stage. So there's a litigation in play. There's a transaction with complexity that needs to be negotiated. There's financial reporting associated with the acquisition and the treatment of assets in a complex situation. And those things happen. I hope anybody listening to this is not being sued or planning to sue. But if they are, those are the places where my expertise typically gets used. It's less price sensitive, I suppose is the way to say it. With that said, I've spent a lot of time working with the Truelytics guys. I've seen their product, and it's unbelievable. I once said I want something like that to put me out of business, and I think they're doing a really good job doing it. Thankfully for me, there's still a lot of complex lawsuits out there and things like that where somebody has to testify. And so far, they haven't figured out how software can testify. When they do that, I'll truly be out of business.
So Terry, obviously, as Owen said, Truelytics can be a great help for advisors or firms looking to conduct transactions or in the need of some more in-depth insights into their business. Are you expecting any changes in the ways that firms are using Truelytics kind of in the environment that we're moving into?
From the one aspect of the core software, which is True Performance, and that does the business intelligence, key performance indicators, and valuation. There's obviously people who are going to be interested in what their business is worth, and there's the changes there aren't a lot, because one of the valuations is a discounted cash flow valuation, which only looks at the future and it takes into consideration risk factors. So that's going to be fairly consistent. And then the others are earnings driven and or revenue driven. And we'll probably have to make some changes here in the next couple months based on what's going on in the market. But at the end of the day, the price or the valuation is just that. It's a point in time. And the bigger part of the software is understanding the drivers of that. Where we've seen a lot of interest is with True Continuity, which we launched ironically in the beginning of March, which is designed specifically for unplanned events. It helps with planned events as well. But if, God forbid, someone got hit by an Uber or got COVID-19 and they were in the position where there had to be a fire sale, we're hoping that it allows for a smooth transition, because it's a locker where everything you need to make sure that business continues to run is right there at the fingertips of those people that you have granted access to and the ability to have that information. That would be the person that you have an agreement with to take over your business. And then we're going to be launching our marketplace here in the next couple months to help matching up buyers and sellers based on data. And that should be in market here in the next quarter.
It's fantastic. Very cool. Well, thank you both for joining us on the show today. Owen, what's the best way for people to reach out to you if they want to follow up? I assume you're going to have a lot of questions based on today's conversation, and a lot of people looking to connect.
Yeah, emails Owen at dahlconsultinggroup.com, DAHL consultinggroup.com. I wish I'd thought of that before I set the business up. And you're welcome to drop me a line. Our office line is 206-707-9260. We're out here on the West Coast.
Very cool. And Terry, we know where to reach you, right?
You know where to reach me. And if anybody comes through and is looking to connect with Owen, we will make sure that we make that connection.
Perfect.
And likewise.
Well, thank you guys. I really, really appreciate your time today. This has been a really informative and a fun conversation. Let's do this again. Three of us killed it.
Absolutely.
Thanks, Mike. Yeah, let's do it when it's not so uncertain.
Exactly. Perfect, gents. All right.
Thanks, Owen. Thanks, Mike.
Terry, a pleasure. Always a fun. Take care.
Thanks,
Take
guys.
care.
Yep. Bye.
Bye.
All right. Thank you very much for joining me for this conversation with Owen Dahl and Terry Mullen. I know I learned a lot, but I also feel like this podcast contributed a lot to you and the broader community, because as I mentioned at the top of the show, this is an incredibly important conversation to have. We are entering this period where, in my opinion, we're going to see a spike in succession, M&A, and emergency continuity plans being enacted just because of the global scale and the magnitude of this crisis, and especially because it is a health crisis as much as an economic crisis. Certain curveballs are coming our way that we need to be prepared for. And the more informed we are about the nuances and how these are likely to affect deals, both in terms of the structure of the deal, the pricing of the deal, and the timing, how quickly they can be completed, and how frequently we're going to see those deals, I think it's a really important conversation to have. So I'm really grateful for Owen and for Terry to join me today and kind of share this information with you. As always, I do ask, I guess is a better word, to please share this with your community, your peers, people in your network on LinkedIn and Twitter and Facebook, wherever you like to share stuff. Forward the email around to a couple of people, letting them know that, hey, check out this podcast. I think it might be important for you to hear, especially if you have people in your network or your advisor population whom you think may be thinking about succession or doing an M&A type activity here in the next year or two. This is something they need to hear, okay? Very appreciative of you for doing that. As always, if you have questions or topics you'd like to see us cover on the show, podcast@truelytics.com, or swing by truelytics.com. Use the little contact form there. We'll make sure that we get that to you. Love to hear from you. It's always very helpful, okay? As we say each week, make sure you wear your mask, wash your hands, wear a helmet, like I mentioned in last week's episode, the racing episode, and stay safe, okay? Stay healthy. We want you around for future episodes of the Modern Financial Advisor Podcast. All right? Have a good one. We'll see you next time. Bye!